Do you ever have that moment when you maybe look at your bank account and you think, wait a minute, how was I spending so much money and I still feel okay? Now, imagine that, but for the entire U.S. economy. I'm Chris Hobart, the Wealthologist, and today we're going to pull back the curtain on what's really been driving the economy these past few years and really why the illusion is fading really fast. Stick around because if you think rising prices and a shaky stock market are frustrating now, you're not going to want to miss what could be coming next. Hey folks, I'm Chris Hobart, the Wealthologist, breaking down the financial headlines so you can actually understand what's going on in the economy, and more importantly, what to do about it. All right, so I want to start with a wild idea. What if everything felt okay in the economy, but only because the government was basically swiping the national credit card like a teenager on a shopping spree? Well, quite frankly, that may not be too far from the truth. Let's rewind just a little bit. For the past 3 years, the Federal Reserve has been, cranking up short-term interest rates to slow down inflation, right? And the money supply, it's been shrinking. Now that right there, that should have slowed the economy way down, and normally it would have. But here's the kicker. It didn't, at least not right away. Well, why? Well, because the federal government was throwing money around like it was monopoly cash. We're talking about budget deficits of over 6% GDP in 2023 and 2024. Now, to put this into context, back in the 1980s, President Reagan got dragged over the coals for running deficits around 5.9%. And that was during a Cold War and 10% unemployment. Now, today, we've had 3.7% unemployment, no major war, and still record-breaking deficits. It's kind of like giving the economy a double shot of espresso and wondering why it's still bouncing off the walls while the Fed is trying to hit the brakes. Now, here's the twist. The caffeine, it's wearing off. Government spending is pulling back. Taxes are going up, and the economy is finally starting to feel the hangover. Tariffs, you ask? Well, those tariffs are taxes in disguise. You see, the Trump administration is raising them again big time. Now, according to the Tax Foundation, these tariffs could rake in 0.85% of GDP. Now, that's the largest peacetime hike of taxes since 1982. Even if the 2017 tax cuts are extended this year, and we expect most of them will be, it won't cancel out the tariff hike. So, yeah, you could be paying more in taxes in 2026, more than you are today, and it's just coming in a bit of a different flavor. Now, while these tariffs are supposed to protect American jobs in manufacturing and businesses, a lot of them right now are stuck in limbo, and we're seeing that in the stock market. Why invest in new U.S. operations if the rules might change again in just a couple of years? That uncertainty right there, that can begin to stall growth. So what does it all mean for you and your wallet and your investments? Well, first, and I know this is going to be tough, don't panic. With the market going the way it is, I understand that is very difficult, but I want you to stay alert. We're already seeing hints of economic slowdown. Real GDP might even be negative in Q1. Numbers drop later this month. Now, stocks are stumbling. Yes, tariffs are the trigger, but here's our take. The market was overvalued to begin with. Even without tariffs, something was going to spark this drop. That's why, unlike most of Wall Street, we really called for a realistic 5,200 on the S&P 500 this year. And as of right now, stocks are back to fair value territory. Now, I want to be real clear on this. This doesn't mean we're heading into a 2008 style collapse, but it does mean we're likely in for some bumps along the way. We've talked about volatility for a while. A recession? It's looking more and more likely, and while it might be mild, it will be real. So what should you do? Well, here's my perspective. First, as I mentioned before, don't panic and make those moves with your investments that you're going to regret long term. If you got a plan, let's stick to it. And if you don't, let's get one. Be ready to rebalance. With stocks back at fair value, now is a good time to review your allocation and prepare for potential buying opportunities ahead. Also, I want you to watch policy closely. Tariffs, taxes, and spending decisions are going to shape the market more than Fed talk in the coming months. And finally, I want you to stay informed, and that's what we're here for. Now, I hope you found this helpful, or at least better than a 3-hour doom scroll on YouTube. But go ahead and hit that like button, subscribe, and share this with someone who's wondering why the economy suddenly feels different and what they might be able to do about it. Now, I do have a question for you. Do you think that the government should spend more to keep things running smoothly, as they have in the past? Or is the wise move right now to tighten the belt to avoid bigger problems and bigger pain later? Drop your thoughts in the comment section below. I read every single one of them. All right, until next time, I'm Chris Hobart, the Wealthologist. Keep learning, keep planning, and keep your money working smarter, not harder.